Okay, last part of the lecture for today. So you should have done this question before coming back to this video. Um, Oops, sorry, I forgot to change the numbers. Numbers change in between edition. That's all they do, and then they charge students more. Okay, so basically we're trying to do this question here. We want to find the book value per share. It's actually pretty straightforward in this case. We take all of our assets, we add all of their value together, we minus the value of all of our liabilities, okay, and then we just take away the value of common stocks. And then if we use that value, this is going to be the book value of the firm for the common equity holder, and we divide this by the number of shares, and that's what the books tell us the value of the firm should be. Okay, this is what I did here. I added up the total value of my assets, 240,000. I added up the total value of my current liabilities, 150,000. That gave me a total value of the equity for this firm of 90,000, to which I minus the value of the preferred shares, which is 70,000, and which gives me common equity of 70,000, and I divided by 17,500, and this should be, I believe it's 4. I calculated earlier, but I believe it was 4, the book value per share. Okay. The last one we need to talk about is the statement of cash flow. The statement of cash flows always have students getting little issues here, and it's really bad if you try to learn it by heart. It's much easier if you try to slow down and think about it logically. I find a lot of students who struggle just try to do this all by heart without kind of thinking logically about it, and then they end up not really succeeding. So just take your time. Don't try to learn any of this by heart. It's when you get big mistakes, just try to go slowly and think about it. This is the same thing I do when I'm going to go over my answers today. Sometimes I make mistakes, but if I just take my time and think about it logically, I can usually figure it out. Okay, so the statement of cash flow, right, just identifies our sources and use of cash. There are 3 parts. There's 3 reasons we can use cash. The first one is for operating activities, either use or receive cash, right? For operating activities, for investing activities, and for financing activities. Students sometimes get confused here by what investing means and financing means in this case. It's actually relatively straightforward when you think about it from the firm's point of view, right? If you think about like Dragon's Den, right? What do people do when they go on Dragon's Den? They're trying to get financing for their firm, right? And what are they going to do? They're going to try to sell a portion of the firm. So they're trying to sell shares in the firm, right? Or sometimes too, they're going to borrow money, so they can also get bonds. They can get debt. Does that make sense? That's what we call financing from a firm point of view. It's trying to finance my activity. So anytime I'm trying to raise funds, or anytime I'm paying back investors for funds that they raised, I'm actually financing my activities, and then the cash flow will go to the cash flow from financing activities. So sale of bonds, common stock, preferred stock, financing activities. Okay, obviously of common stock in the company we're talking about, right? And bonds that of the company we're talking about. If we're selling other bonds, it might go somewhere else. So at the same time, right, the opposite, whenever we pay money to the people who financed us, it's a cash flow for financing activity. So we pay dividend, it's a cash flow for financing activity, right? We retire or we purchase our debts, some common stock, some preferred stock, we're financing the firm. It's the opposite. We're not getting cash, we're getting rid of cash, but it's still a financing activity. Okay, investing, right, is going to be investing in factories and machine. That's the first way firms invest. And the other thing is they could invest in investment, right? So when I said earlier, I kind of said, well, the stock of this company, a company could own stocks or could own long-term investment. But these long-term investment that it owns that are kind of assets for that company, these are investing activities, right? So investing in financial asset, okay, long-term investment, or investing in the assets of this company, plants and equipment, so on and so forth. Obviously, the other side is going to be the opposite. Here we have the cash inflow, here the cash outflow, right? So the other side is just the opposite. We have inflow when we sell plant and equipment. We have inflow when we sell long-term investment. We're going to have outflow when we purchase them. Finally, there's operating activities. So the distinction between these two is usually students struggle with this. So try to be careful. So try to think about what I just said here. Hopefully it helps you think about these correctly. The last one is usually not that complicated, at least conceptually. It's cash flow from operating activities, right? So anything that comes from our normal operating activities, like what the business is doing, will go in here. Okay. So that's it. And then we need to separate into these three, and we're going to do it with an example, and we will be done. Okay. So the statement of cash flow from operating activities, right? There's two ways to do this. By the way, I only go over the indirect method here because most corporations will use the indirect method. But if you work, and I mean, you're going to learn that again in accounting, but if you work with smaller firms, single proprietorship, sometimes they use a direct method, but I'm going to talk about the indirect method because the direct method is way too complicated for bigger firms, bigger corporation. Okay, so the way we find the cash flow from operating activity is usually backward. Okay, big firm will not track all cash expenditure always. So instead, what we do is we start from the income statement and then we kind of reverse everything that we did. Okay, so the way we're going to do this is we're going to start from the income statement. Okay, and then we're going to add back anything that we charge the firm that was a non-cash charge, anything that we use and is an expense and that wasn't actually an expense. Okay, the most obvious one here is amortization. Okay, amortization, we charge it right on our income statement, but in fact we didn't pay any money. Right? Amortization just represents the fact that the value of the firm decrease over time, or at least the value of the assets of the firm decrease over time, like plants and buildings and machine decrease over time, trucks, their value decrease over time. So we charge the firm, the government allows us to lower our income by this amortization value, right? But it wasn't actually an expense. So we need to add it back because we didn't spend any money to incur this charge. Okay, so we basically add back all the non-cash charge, right? And we take away our non-cash gains. After that, anytime a current asset goes up, right? Think about your inventories going up. If your inventory goes up, it means that you acquired more either primary resources, something like that, and you must have paid for these primary resources. So an increase in your current asset is actually a use of fund. You spent money to increase your inventory. Okay, your receivable went up. It's an increase in your current asset. You used fund to increase that. At the same time, if your inventories went down, okay, then it's a source of fund. Okay, it's the opposite. And then for the current liability, it's going to be the opposite, right? If your liability goes up, if your account payable go up, it means you didn't pay, right? You paid less than you incurred in costs, right? So it's actually a source of cash, right? So it's a source of fund. On the other end, if your account payable went down, that means you must have used cash to pay that account payable, and it's a use of fund. Okay, does that make sense for everyone? So I have this here. Again, you can look at it this way, but try not to learn these by heart. That's what I said earlier. If you try to think about these logically, I think it works a lot better. It's a lot easier to do if you try to think about them like just learn this by heart here, like plus amortization minus the increase in the current asset. I think this gets complicated and a lot of students make a lot of mistake. I never kind of try to remember this by heart. I always try to just do this by logic. It's the simplest way in my opinion. Okay, sorry. So if we look at this statement of cash flow here, there was net income and amortization charge on the income statement. Sorry, this is a balance sheet, sorry, between two years. And in order to do our statement of cash flow from operating expense, we need to start at our net income, which is given in the income statement I gave you above, which was 110,500, and we need our amortization, which was also in the income statement above, which was $50,000. So if you remember correctly, what I told you here, we start at net income and we add amortization and other non-cash item, right? So we start at this and we add 50,000. Okay, then we need to go through our balance sheet, right? And we need to find minus all the increase in the current asset and plus all the decrease in the current asset, so on and so forth. Again, I'm not doing it just following a formula here. I'm just doing it logically for you because I think that's the best way to remember it and not forget it for the rest of your life, right? So here, this is a previous year. I don't know why they call 20XW and 20XX, but this is the previous year. This is 1 year ago. This is this year. Okay, so that's the past. That's now. And then we can basically go through all of these asset and look for which one changed. We don't consider the cash because we're making a statement of cash flow here. So we're trying to find out where did that increase in cash by 10,000 came from, right? We can see an increase in cash, and the statement of cash flow should tell us that at the end. So we don't consider the cash. We ignore this line of the balance sheet. Marketable security, nothing changed, but we see that account receivable, right, went up by $30,000. Okay, if our account receivable went up by $30,000, it means we received $30,000 less in payment than we should have, so that the account receivable goes up. This means that we basically provided credit to people. It means it's a use of cash, right? So this increase in $30,000 should become a minus $30,000 here when we calculate our statement of cash flow. Okay, same thing. The inventory went up, right? Our inventories went up, so I bought more primary resources, right? If I bought more primary resources, I must have used cash to purchase them, right? So we have another use of cash here of $20,000. Okay, the prepaid expense here went down from $30,000 to $20,000. Okay, so I paid less. Like I basically stop making some of my prepayment on some expenses, right? And that is a way I save cash. This is a source of cash, which is plus $10,000 in our statement of cash flow. So I think I've done all of the current asset. So if we go back here in the statement of cash flow, right, we start at our 110,500, which is our net income. We add the $50,000 amortization. Okay, and then we make all these adjustments I just told you about the current asset. Now we didn't do the current liability, so these two I didn't do, but I did the current asset here. Okay, I told you the first $30,000 comes from the change in account receivable, and I told you it was a use of cash, so it should have been a negative, right? The increase in inventory was a use of cash, negative, for the difference between the two values, right? And the decrease in the prepaid expense was actually a source of cash, so a positive amount of cash that we got. Okay, I think you should probably stop the video right now, look here, and think about what happens with our current liabilities, and will it be a source of cash or a use of cash? I'll let you think about that. Okay, you should have thought about it. We see that the account payable went up from $45,000 to $80,000. This is sorry. This means that we didn't pay, right, our suppliers, right, as much. Like we basically got more credit from our suppliers and we need to pay them more money now. So this is actually a source of cash. We found some cash by not paying our suppliers right now. So we should see an increase here in, I think this is $35,000 because of account payable as a positive cash flow. Okay, the last one that happened is the accrued expense, which went down, so it should be the opposite. It should be a negative $5,000. Okay, so if we look at it here, exactly what I just told you. Okay, so these numbers, all these numbers sum together, minus 30,000, minus 20,000, so on and so forth, just all these sum together gives us that there should be minus $10,000 change in our cash position just from this change. So our cash flow from operating activities should be this amount, 160,000 minus the 10,000, which is the sum of all of these, 150,500 is our cash provided by operating activity. We finish the first step only. Okay, now we need to do all the other step. I have the other twos right here. Okay, for the statement of cash flow, we have the statement of cash flow from investing activities. Okay, this one at first, most of it is pretty straightforward. I think most of it will come from long-term asset, right? Because it's investing activity. As I told you earlier, it's investing in either the plants and the manufacturers that we use for our operation, or investing in long-term securities. Okay, all of these will show up in long-term asset on our balance sheet, and it's pretty straightforward if you've understood how to do the adjustment from the statement for operating activity, because it's the same idea. Right? If our PPE went up, if our plant, property, and equipment went up, we must have used fund in order for this PPE to go up. So any increase in the PPE is a use of fund. Okay. Same time, if the PPE went down, we must have been selling this PPE, so it must be a source of fund. Okay. Same thing for investment. If investment went up, our long-term investment went up, we must have been using cash to purchase these long-term investments. It's a use of fund. For financing activity, again, that one is also, I think once you understood how to do the statement of cash flow for operating activity, I think all of these become relatively straightforward. It's the same idea here, but a lot of them are just expenses that happen because of business operation. Okay, so statement of cash flow from financing activity will usually include dividends. Right? If I pay dividend, well, I need to have cash and be able to pay that dividend cash to my shareholders. Okay, so any dividend, preferred or common share, is going to go here. Okay, the other thing is I might be paying back my common shares. Right? I might be buying back doing a share buyback, and I buy back common share or preferred share from investors, or I might be buying back bonds, or I could be selling share and selling bonds. Okay. Obviously, right, an increase in the amount of common share means that I am selling shares, means that I'm getting fund, so it's a source of fund. Right? If there's a decrease in the amount of common or preferred share, I must be buying back these shares. I need to buy them back with cash, so it's a use of funds. Okay, and the same idea with bonds. I won't repeat that one. I think it's pretty straightforward, hopefully, at this point. So if we look here, these were information given to us in the previous financial statement. Sorry, in the previous financial statement. If we tried to do the statement of cash flow from investing activity, I told you we want to look at the long-term assets of the firm, so the assets that are in this area here. Okay, and we can see that the long-term investment went from 20,000 to 30,000. So I bought more long-term investment. I must have paid them with money, right? So I need to pay $30,000. 30,000 negative should go in my statement of cash flow for investing activity. At the same time, the plant and equipment also went up by 100,000, so I should have also here a use of cash of 100,000. So these two numbers are use of cash. It should show up negatively in the statement of cash flow for for investing activity, and I have this here. Okay, and we see that they both show up, and we have a use of cash of 130,000. Okay. Um, my bad. Sorry. For financing activity, obviously we have our dividends paid here. Okay. We also have to look at what happened to the preferred stock and the common stock, but here there has been no change in the common stock and preferred stock, so we didn't issue new shares or we didn't buy back new shares, so nothing happens here. We do notice that the bonds payable went up by 90,000 though, which implies that we sold for, sorry, not went up by 90,000, went up by 50,000 to 90,000, which must imply that we sold new bonds and we got $50,000 here. So we can look at our financial statement of cash flow for financing activity. We got $50,000 for the bond that I just talked about, and then we paid our dividends, right? And then we can see that, well, we lost $10,500 from our financing activity that we had to pay out. We can put all of this together. I won't repeat because this is just repeating everything I just said earlier. Okay, but if you put all of this together, our 150,500 from the operating activity. Okay, we used $130,000 in investing activity. Okay, and we use 10,500 in financing activity. This means that we have $10,000 increase in the value of our cash and the amount of cash we have from previous year. In the previous year we had $30,000, means we have $40,000 now. And this can be seen here, right? We had $30,000 and we now have $40,000. The difference of $10,000 comes from everything I just explained, which you should be able to do. It's tedious, it's long, but it's not that difficult if you take your time to do it correctly. Okay. So I have this question here for you. I would like you to take a minute and try to do this, and then I'll be back and I'll help you hopefully go through it. Okay, you should have stopped it. If you didn't stop it now. And here is my answer. I just want you to identify the adjustment here. You don't need to like do a whole the whole exercise of doing the statement of cash flow for all activities. I just wanted you to identify the adjustment. I have found out that students struggle mostly with these adjustments. The rest is pretty straightforward, but then figuring out the adjustment is where a lot of students make mistakes. Okay, again, take your time. If you take your time, it's pretty easy to do. You won't make a lot of mistakes. My inventories went up. Ooh, the 2 dates are the same. You know, they're not. Okay. The inventories went up by $100. Right, if my inventory went up by $100, it means I must have been using cash, so it's a use of cash, so I should have $100 negative that will show up in my statement of cash flow. Okay, account receivable went down by $350, so I need to collect less from my client, which means that I have found a source of $150 here. Okay, the account payable, I won't do these two. Because I think it's pretty much the same idea. We just look at the same direction because PPE is an asset, right? So you just look at the same direction as these two here. And then I'll do account payable. Account payable went down from 800 to 700. If account payable went down, it means I must have been paying my account payable, so it must have been a use of cash, so I should have a negative $100 in my statement of cash flow from operating activity. Okay, and again, I'll skip the PPE and the long-term debt. You should be able to understand that, hopefully. I'm just trying to not bore you. Yeah, anyway, if you want me to re-explain this, just ask me, and I'll be happy to do it. Okay, the last thing I want to discuss, there's two things I want to discuss. One of them I didn't put here. It talks about tax, and the reason I didn't put it here is that we will talk about tax a lot more later on. A couple of things that I want you though to know about tax, even though I didn't write it here. The first thing is that the tax rate for investors directly is different on different kind of financial asset. Okay, the capital gain tax is different than the tax rate on dividend, which is different than the tax rate on interest. right? If you're an investor and you earn income that is interest or that is capital gain or that is dividend, your tax rate is going to be different. Well, would potentially be different for all of these three. Some investor might be in a category like a small minority where all of them are equal, but that would be pretty rare. For most people, these tax rates are all different. Okay, and that's an important consideration when we talk about financial management. If we're trying to talk about do we want to raise funds, right? How it's the best way for us to raise funds cheaply. If investors are taxed a lot more on capital gain and on dividends, well, maybe they prefer receiving payments in the form of interest then. And so it might allow us to raise fund at a lower cost if we're able to identify how investors are taxed. Okay, and for the same reason too, there is a tax rate that is flat, usually per province, on the profit for firms. Okay, this tax rate varies per province, and there's usually two different tax rates depending on how big a firm is. Smaller firms have a different tax rate than bigger firms. But that's all I want to say for now, and also that, as you might have noticed from the income statement, interest expense for the firm's point of view generate what we call a tax shield, right? Because the interest is subtracted from our earning before we calculate our taxes. It kind of creates a tax shield and it protects us from having to pay an expense, and that's one consideration too that we'll talk about later. The last point that I want to highlight is the idea of free cash flows. A lot of students, when I've taught this class in the past, a lot of students never heard about free cash flows before. They are an extremely important concept in finance. There's two of them that I'm going to talk about in this class. There's many different free cash flow, but one of them is the free cash flow for the firm or to the firm. Okay, and there is also the free cash flow to the equity holders. Okay, as investors, right, what we care about is how much free cash is generated by the activity of a firm and how much of this free cash we can use to reinvest or to pay out to us investors in this firm. Okay, there's two concepts we can use to think about that free cash flow. We can think of the firm as a whole entity, including the debt holders and the equity holder, right? Think about it. We generate activities. We have cash flows from operation. What do we need to do with that cash flow from operation? Well, we're free to give it basically to debt holders or to equity holders. Okay, and that's what the free cash flow to the firm is trying to generate as a concept. Okay, and it's really useful when we're trying to value the whole firm. So if you were trying to buy, right, a whole firm, including its debt and everything else, right? That's a value that would be really valuable. That's a number, the free cash flow to the firm, that would be really valuable to you. Okay. So now, how do we calculate the free cash flow to the firm? Pretty straightforward. I have it written right here. Okay. It's your cash flow from operation, CFO, to which you add 1 minus the tax rate times your interest payments, right? Your interest expense. To which you minus capital expenditure for maintaining the operation of the firm, right? So just capital expenditure. Hopefully that's pretty clear. One thing where I often get questioned here is, Francis, why do I add 1 minus T interest into my CFO? The reason is that when we calculate the cash flow from operation, CFO, by the way, is what we calculated here, right? That's the CFO, the cash flow from operation, what we did in this situation here. So why do we add back the interest? Well, so ignore the minus T first, right? Ignore this minus T here that we have. Why do we add back the interest? Because when we calculated the cash flow from operating activities, CFO here, right, we took the net income to which we added the non-cash charge, but in the net income, right, we minus our interest payment. our interest payments were taken out of this. This is how we found the net income from the income statement. We minus the interest payments. But if we're interested to the cash flow, all of the cash flow that the firm generates for all of the investors in that firm, we need to add back the interest payment. Okay, why do we add back 1 minus t? Because the interest payment generated a tax shield, right? Generated a tax shield of t percent. And so it didn't actually, like, not all of it is cash that is available. Only the portion that was non-taxable is available for us, and that's why we add this value here. Okay, a different way to write the free cash flow to the firm is this one here, but hopefully everyone can see that these three elements here are just the CFO. These are just the cash flow from operation, right? Your net income plus your non-cash charge, like amortization, to which you minus your working capital expenditure. Okay, this is exactly CFO. This is exactly how we calculated CFO earlier. So writing it this way or this way is actually exactly the same thing. Okay, the FCFE, the free cash flow to the equity holder, is the exact same concept, and this concept is useful if we want to value the firm from the equity holder point of view. If we just want to think about the equity and how much the equity of a firm is worth, right? This is the free cash flow that you have available to yourself as a equity holder in this firm. Okay, so we start with the CFO, right? The cash flow from operating activities. We minus the capital expenditure. We do not add the interest payments here, 1 minus t times the interest payment, because we're not worried here about the debt holders anymore. We're just talking about or interested about the cash flow that equity holders can get and generate, and then we add the net borrowing. Okay, so these two cash flow are pretty interesting and pretty important. We're kind of going to leave them aside for now until we come back to valuing the firms, and then we're probably going to talk about these a little bit more. But right now, I just wanted to introduce them. Okay, I think this has been about an hour 20 minutes, as I told you at the beginning. I think this is a slightly shorter class because I think last one was pretty long. You had a lot of things to do, so I wanted to give you a shorter one, and I'll see you next week. Have a good day.